Good morning, ladies and gentlemen, and welcome to TaxCraft, Q2 of the year 2026. TaxCraft is Ichiban quarterly call where we discuss the latest tax developments and the updates from the last quarter and their impact on you as a taxpayer and your business. My name is Mercy Maina. I'm the communications officer here at Ichiban Tax, and today we'll have three speakers speaking to us. We'll have FCPA Roberto Ariro. He's our partner here at Ichiban Tax. We'll have CPA Nathan Kiptui. He's our principal tax advisor, and Margaret Mutinda, who is our tax and regulatory advisor. Please note, our today's session will be a bit longer than our usual 40 minutes to allow us discuss the recent changes that we have seen in the Finance Act 2026. My colleague Mercy will put a link in the chat. Please take a few minutes and give us your feedback. Also, as we go along, please put on your questions in the chat. We will address them when we get to the Q&A session. Without much ado, allow me to introduce our first speaker, Robert. Bob?
Thank you. Thank you very much, Mercy, and good morning. Good morning. Always a pleasure to speak to you around the tax changes that we have seen. And what we want us to go through this morning is the Finance Act 2026 changes. There have been quite a number of them, as Mercy has said. We'll also look at recent case law in terms of how that may impact your business and what you need to know, both in Kenya and outside Kenya. We'll also look at regional developments. There have been some interesting developments that we perhaps need to compare with as we go along. And as always, we'll have an interactive session where we can exchange notes and see how best we can take this conversation forward. So without further ado, let me just dive straight into the income tax changes, because these have been quite numerous in the Finance Act 2026. And so what are some of the things that we are seeing from a Finance Act perspective? Number one, there's been this conversation around the interchange fee. And if you remember how this conversation started was ABSA, then Barclays, had a dispute with Revenue Authority about whether there was withholding tax applicable on the interchange fee. And that dispute went all the way to the Supreme Court, where the Supreme Court held no, there is no withholding tax on this interchange fee. And so what has government done? Government has now defined management and professional fees to include interchange fee. And as a result of that, we expect that there's going to be withholding tax on that interchange fee and reverse VAT, because remember, this interchange fee is charged by the likes of Visa and MasterCard and Amex. And so because they are not resident in Kenya, then these banks are importing that interchange fee, there will be a reverse charge VAT. So clearly, there might be a change in terms of the pricing by banks, or depending on who is going to take care of that cost. The second change, which is really a cleanup, we've seen two definitions coming in, and especially this is interesting because Finance Act 2025 brought in some new definitions, and as well 2026 we can see that. So we can see withdrawals have now been broadly defined to include any amounts disbursed to players, as well as winnings being defined to include what you win in a lottery or prize competition. And that means that now those kind of winnings will be subject to withholding tax, and especially when it's being disbursed to the player. So for the gaming sector, that's probably something that you need to think about, and especially when you think about credits that are, or what they call free play credits, so that you then subject them to appropriately to tax. We've also seen then an enlargement of the amounts that are subject to withholding tax, scrap metal coming back. This is an interesting one because, again, last year it was there, it was removed, then now it's back at 1.5%. So some changes around just cleanup and application of those rates. A very good one that has come through is the one on bad debts for financial institutions. Again, there's been a lot of debate around whether those kind of expenses are deductible for corporation income tax purposes. And so the law has now been clarified. It's very clear. If you've got a bad debt as a result of a loan not performing, and you are a financial institution or a microfinance institution, then that becomes an allowable expense. And I think that's really good clarity for that sector. Again, for the gratuity, we have seen a lot of debate around the taxation of these terminal payments. Remember, in 2024, 2025, we've seen quite a number of changes around how to tax pensions and gratuities. Now, the gratuity provision in the Finance Bill 2026 had 3 conditions. So you needed to have served for at least 3 years. The gratuity payment was less than 31% or at least 31% of your basic pay, and then you should not have benefited from a contribution to a pension scheme. The problem with the third condition, which has now been dropped, is that all employees contribute to NSSF, and NSSF is a pension scheme. And so as a result of that third condition, nobody would have qualified for a gratuity exemption. But now the Finance Act has removed that third exception, so you only have 2 exceptions that you need to deal with. Again, a clarification around the taxation of non-resident rental income tax, which is still due on 20th of the month, and that is at 30% for fixed property, or what you'd call land and buildings, and then other property or movable property is at 15%. One other change that just suggests that we need to review our tax stability policy is in 2025, we had a change on the freight tax or shipping tax. Now, this is the tax that is paid by owners of ships when they carry cargo out of Kenya. And in 2025, the law was changed so that withholding tax, or that income, is subjected to withholding tax by the person who is shipping the goods. And what happened as a result of that is that KRA came from collecting this freight tax from about 50 or so shipping agents to probably 10,000 people who are shipping goods, which made it administratively cumbersome. As a result, now KRA has, or the government has revised the provision and now says we are going back to the agents computing and deducting this tax, but it will be due 5 days after collection or when the ship sails. Now, one of the challenges that we can see with this sector is that what happens to goods where the freight is paid by the person who is receiving the goods, say in China, so where does that withholding tax come from? Who pays it and who's going to finance it? So those are some of the practical challenges that we can potentially foresee with respect to that change. Then a cleanup, just to clarify that any entities that are subject to qualifying domestic minimum top-up tax, this is a mouthful, but it essentially is a global initiative to ensure that companies across the world pay at least 15%. That is, companies whose annual turnover is 750 million euros or more in a year. So those entities are required now to file their country-by-country reporting, that is the CBC, country-by-country reports, so that Revenue Authority is able to have visibility about that obligation and then can follow up. A good one for the insurance sector is that the Income Tax Act now clarifies that fund is, or the statutory funds are now covered for purposes of tax. What happened in the past is that the law said life fund. And so there was a question as to whether the other funds which are required to be maintained by these insurance companies under the Insurance Act were covered. Now it's very clear that they are covered, and that's a good clarification that we can see there. You and I will have to now file our returns by 30th of April, 2027, for example, because remember, this provision is effective 1st January 2027, which means that for the year 2026, you and I have to file our returns by 30th of April as individuals. Then as companies, you still have up to an additional 2 months after your year end to file the return. And the idea here is to try and limit the volumes that we have seen over the last, about a week or so before the deadline date. You'd be surprised to note that KRA receives about 100,000 returns a day, about 1 week before the end of June. So just to manage that traffic and the availability of the system, that change has been made. It's a good one because remember in the finance bill, there was a proposal that nil filers should file by 31st of January. That one has been dropped. And so we now have 2 dates, 30th of April for individuals and the end of 6 months for non-individual filers. Again, just aligning with the medium-term revenue strategy around the pensions and the taxation of those pensions. Now, the payments that are made upon the death of an individual to his estate or her estate, those ones are exempt from tax. So that's a good one. And as well, another cleanup is the exemption of the capital gains tax with respect to properties transferred to a real estate investment trust. And that's really a good one, because then you're encouraging development of these asset classes and this line of business. The other changes that we are looking at from an income tax perspective, a clarification around the rate applicable to industrial building allowance. Now, previously, it just said there was a 10% rate. It was not clear whether it was straight line, reducing balance, or what basis you'd use. Now, it's very clear. It's 10% on a straight line basis, and that's a good one. We also seen the government trying to contain or ensure that it protects its tax base with respect to restructuring and where there's a sale of shares. So now it's very clear that where you sell a share and the value of the share is derived from Kenya, or the sale results in a change in the group membership of a company in Kenya, or in the ownership of property in Kenya, say land, then that will be subject to capital gains tax. So it's now very, very clear. And, we have seen other countries and other decisions, for example, South Africa, trying to also protect their tax base from a capital gains tax perspective. A cleanup with respect to the taxation rate for repatriated income for the mining sector or the extractive sector. Again, that is aligned to the normal repatriation rate of 15%. One that we expect to generate a bit of controversy is the tax losses provision. And this one is an interesting one. Why? Because in 2025, the Finance Act was amended, or the Finance Act amended the Income Tax Act, so that losses are limited to 5 years. Now, the problem we have with that provision in 2025 is that it did not have a transition provision, meaning that we have interpreted it that the tax losses, you start counting 5 years from 2025. KRA, on the other hand, has a different interpretation, and their interpretation, and they have actually issued a memo to this effect, is that any losses that were 5 years old as of June 2025 are out. And so if you file your return, you probably have noticed that if you had 2019 tax losses, those ones are no longer available. And this is the reason why we are saying we expect a bit of controversy. And this is especially because of this Vijay Kumar case, where the tribunal ruled that you cannot apply that provision of tax loss carry forward restriction retrospectively, meaning backwards. And so the tribunal has already pronounced itself on this, but KRA has appealed this decision to the High Court, and KRA's decision to appeal is premised on the fact that the taxpayer did not plead, specifically include that in their provision, in their filings for the Tax Appeals Tribunal. And so KRA's argument is that the tribunal made a decision on a matter that was not in dispute before the tribunal. And that's the reason why we are saying it's going to be a problem. So how has the Finance Act 2026 tried to address this? It has introduced a transition provision, but only if that loss arose as a result of an investment of 10 billion shillings in the 2025 year of income or before. Now, 10 billion shillings is quite a big threshold. So we don't expect that there are very many people who will qualify for that transition provision. And this is the reason why we expect that there's going to be a bit of controversy around that. So that's just a snippet of the key changes from an income tax perspective in the Finance Act. And I now want to invite my colleague, Nathan, to take us through VAT. Nathan?
Thank you very much, Robert, for that insightful presentation on the changes to the Income Tax Act. Ladies and gentlemen, now allow me to take you through the changes to the VAT Act. And to begin with is, sorry about that, just a moment. So to begin with is the provision to introduce Section 17A to the VAT Act, which talks about accounting for input VAT upon reclassification of goods to exempt status. And it says that where you've got unsold goods in your stores at the point of goods being classified to exempt status, then you are now required in law to account for the input VAT that had been previously claimed, so that you pay the excess of the VAT to the Revenue Authority. Secondly, we look at the clarification of finance charges that are exempt for VAT. And the law now has defined finance charges that are specifically registered under the hire purchase agreements. So if you're dealing with these services and you're not registered under the Hire Purchase Act, then that means you need to charge VAT on the services. Another amendment to the VAT is the bad debts timeline, which now has been moved from 2 years to 3 years. This has a tax cash flow implication on taxpayers, in that you will have to wait for a longer period in order to claim a refund on bad debts. And another provision that also has been defined in the Finance Act of 2026 is the definition of tour operators. Remember, under the first schedule, services charged by tour operators are exempt from VAT, excluding services that are in-house in nature. So the Act has now defined tour operators are those licensed under the regulatory provisions within that sector. And again, it has gone ahead and defined what in-house supplies are. And this has been defined to mean that if you've got any other service outside tour operation that let's say resale in nature or third parties, and you materially restate those services, then those services are subject to VAT. Another critical VAT amendment is on VAT on exclusion of VAT on outsourced labor. And remember, in the past years, we've also seen a lot of long-standing disputes between the Kenya Revenue Authority and taxpayers. And one critical case law that is on record is the one for strato staff, where KRA has always sought to tax or charge VAT on the management fee and salary aspect of it. So the Finance Act now clarifies that aspect and excludes what do not belong to the VATable nature of services, which now is the salary and other deductions. Now, having looked at the provisions on the finance on the VAT, let's look at movement of goods and services from the exempt status to VATable status. And there are quite a number. We've picked a few. And this, the first one is settlement or merchant acquiring fees that are charged by payment service providers. And these have been specifically classified under the VATable status. And this includes charges or fees charged by companies, including Pesapal, KenSwitch. And this has now been expressly classified as a VATable service. On to construction, we've also seen that any materials that are used in construction of facilities or recreational parks of over 50 acres are now exempt, are now VATable in nature. So if you in that sector, any construction of over 50 acres, then you need to charge VAT. Again, in the sector of aviation, we've seen that compasses, instruments, and appliances, and other aircraft spare parts have also been classified as VATable supplies. So this as well have been, that means that under this category, all these services and goods will come with a higher value. In terms of movement from either standard rated or zero rated, we've also seen that a number of supplies have been classified as exempt. The first one is dialyzers of tariff code 8421, which is more or less about the apparatus used in laboratories or hospitals. So this means that this supply will be a bit much cheaper. So another exemption is supplies to the National Infrastructure Fund projects. And we've also seen the president very passionate about this. I think 2 days ago, we also saw a boat that had been gazetted, and the supplies to those projects are now exempt. Another sector which we've also seen an exemption is the construction of LPG storage tanks. But then the catch is on the investment of over 5 billion, which is also quite a significant amount. So supplies to construction of such are now VAT exempt. You and I, when we travel outside the country, we also come along with the personal effects of some goods. So the threshold for the tax-free threshold has been expanded from the previous 300 USD to 2000 USD. So this means that if you've got an iPhone coming along with you, so you will now be allowed to come with a tax-free window. The other significant amendment or movement of goods from zero rate to VAT exempt are raw materials used to manufacture pharmaceuticals upon recommendation by the CS. So this way, we are looking at this from a cost perspective, because remember, any product that is VAT exempt, you're not allowed to claim input VAT. So this means that if these goods have been moved from zero rate to exempt, so that quantum for the input VAT will be passed on to the consumer. And having looked at those, now allow me to take you through the Tax Procedures Act. And there are quite a number of amendments under the Tax Procedures Act. The very first one is the Tax Amnesty Program. So this is a reintroduction of Section 37E to the TPA Act. And this provision has now allowed taxpayers to utilize a window period of 6 months from 1st of July 2026 to 31st of December 2026, where now you are required, if you've got any penalties on interest covering the period up to 31st December 2025, those ones will be exempt if you regularize your account within the 6 months window period. In terms of crypto exchanges, remember late last year, there was an act which was passed into law on virtual asset service providers, where the Revenue Authority are trying to bring up this sector into the tax base. However, we also note that the regulations for this sector has not been published, and the requirement under the Finance Act is for institutions in this sector to file annual information returns, where now you declare or you are required to declare who are the players within the platforms. And of course, this should be done under the law and within the confines of the law and data protection. One more amendment to the TPA Act is the requirement by non-residents to have a PIN when they are opening a bank account. So this is not the case currently with the Finance Act. So if you are a non-resident and you want to open a bank account, you are exempted from acquiring a PIN, and this basically is to mean that foreign investors are encouraged to invest within the country. In terms of the commissioner's powers, we've seen that the Kenya Revenue Authority have been given the power to disregard tax avoidance schemes and assess you. And this basically means that the Kenya Revenue Authority will look at your tax structure or tax planning measures. And if they realize that, or they find that you've evaded on tax, then they now have the power to disregard those schemes and assess tax on you. Another power which the Kenya Revenue Authority have been given under this act is the power to collect unpaid fees and levies. Remember, currently the Revenue Authority are the agents to levies like affordable housing and NITA. So this has now been anchored in law in such a way that they're able to collect levies that are unpaid or are in arrears. Also, in terms of the tax procedures, we've also had the dual assessment regime that has been enacted. So this means that, and we've seen even during this filing season, that KRA pre-populates returns where they collect all the information from sources like eTIMS and even withholding and customs. So this has also now been enacted into law, where KRA will look into your ledger and then provide you a pre-populated return. And according to the provision, it states that the Kenya Revenue Authority should do that only up to the 31st day of January of every year, and then give you a window of 2 months to amend or file your return. And this means that we will have more compliance measures coming in the near future. In terms of compliance with eTIMS, KRA are also, it has been passed now under the law that non-compliance with eTIMS will have a penalty of either the higher of 2 times the tax due, or Kenya shillings 100,000 for corporates and 10,000 for individuals. So this basically is to discourage or encourage people to onboard on eTIMS and comply. On to another amendment to the Act is the production and maintenance of export declaration for imports. And this also, remember, within the same Act, we've seen that the provision on certificate of origin has been deleted, but then this provision has been brought into the Act. This means that when you import goods, you need to produce the records. They can either be certificates or bill of lading documents and such, and keep them for the period of 5 years. Yeah, as required by the Tax Procedures Act. The second last amendment to the TPA is the waiver of penalties and interest. So the Kenya Revenue Authority has been given a limit of up to, as the ceiling is 2 million Kenya shillings. So they cannot waive penalties and interest on penalties and interest arising from errors from the electronic systems. And as I conclude, there's also a change in law on the registration of Kenya KRA pins. And now the Revenue Authority have the power to re-register previously registered pins. So they not necessarily need to issue you with a new pin if they find that you evaded tax. So we will be on the lookout on the changes, as most of the changes have been implemented from the 1st of July 2027, some in September and others in January 2027. So having looked at that, now allow me to hand over to my colleague Maggie to take us through the excise duty changes.
Thank you, Nathan. Quite interesting changes there, as you've said. Now let's look at the changes to the Excise Duty Act. First, we have an interesting change in float glass, which is the material used for windows and glass doors. So now this float glass, which is sourced from East Africa Community and meeting East Africa Community rules of origin, will now be subject to excise duty. This would then result and translate to higher cost in terms of people who are constructing, as these materials now, their prices have gone really high. And also, we see that this provision is problematic on another ground. This is a departure from East Africa Community Customs Union Protocol that allows for preferential treatment for the East African community. So we also anticipate a bit of agitation and pushback on this provision in that regard. Antique, vintage, and classic vehicles are now subject to 50% of accessible value of their accessible value. Antique, vintage, and classic vehicles are motor vehicle whose year of first registration is at least 30 years before the date of purchase of the motor vehicle, and whose value is at least 10 million shillings exclusive of depreciation. So this would definitely increase the price of these luxury vehicles. A win for the manufacturing sector, particularly targeting exempt goods for the defense welfare services. These exempt goods are such as uniforms, footwear,
foods and drinks sold in their canteens, as now they qualify for a refund in input used in manufacturing of these exempt goods. This is such a win as it would allow for a lower cost in the manufacturing, increase in cash flow, definitely a win for the manufacturing sector. We also see another change where there will be an extension now on definition of betting and gambling to include chips, tokens, tickets, and promotional bets, which were previously not and are subject to the excise duty, as now they will be they'll now be subjected to 5% of excise duty. This is just to capture a wider range of transactions. Looking further, there are several goods that have been moved from their previous rates into new rates through the Finance Act. First, bottled and packaged drinking water is now non-excisable, which is a welcomed move as it will reduce the cost of bottled water. An action point for bottled water manufacturers is to return all unused excise stamps to the commissioner. I'm sure the commissioner will issue directives on the return of these stamps, and also to deregister from the obligation in the event that they don't manufacture other accessible goods, so that they avoid incurring any penalties in that regard. A clarification we see on the threshold applicable on inputs and ceramic sinks, wash basins, and similar sanitary fixtures is now there's a clarification that whichever is higher of the two rates would be applicable. Before, it was just a provision of rate and there was no clarity, which is a welcome clarification. A third change that we see, which will really impact construction, people who are looking into constructions. This is the imported ceramic flags, pavings, wall ties, and the like, which were previously at the rate of 5% of the accessible value, or 300 shillings per square meter. They are now at the new rate of 5% of the accessible value, or 50 shillings per kilogram, whichever is higher. So on the face of it, it doesn't look like this provision would have any impact. However, considering that a square meter of a tile is approximately 10 kg, translating the same to the new rate applicable, which is 50 shillings per kg, that would result to about 500 shillings, an increment of 200 shillings on the same. This would definitely impact and cause higher cost for people who are in construction, and definitely this cost would also trickle down to the common mananchi in the housing, as in terms of housing costs, and also accommodation fees for the people who are in hotel industries. Added sweetened fruit juices and those with added sugar have now moved to a new rate of 20 shillings per liter. And a new provision, which is a win also for the local sugar production and manufacturing in Kenya, is that imported sugar now is at a new rate of 40 shillings per liter. This is 5 times an increment from the previous rate. This now protects and encourages local sugar production and manufacturing in Kenya. Similarly, we see other provisions that introduce goods that were previously not subject to excise duty are now subjected to excise duty. Starting off is the imported particle boards, MDF, block boards, plywood, timber. These are used in construction, interior wall flooring, furniture. And we see that this change now with a new rate of 30% of the accessible value, and also considering the 16% additional VAT that would be imposed on this value, would result to very high cost for those who are in construction industry and production of furniture. And ultimately, this cost would also be passed down to the consumer in terms of housing fees. If you're renting a place somewhere, the rent will definitely go high. And also for accommodation fees in terms of Airbnbs and hotels. The same would apply also to shower heads, which are used for domestic and commercial use, as they are also in the construction and housing space. The advertisement and marketing sector has also been impacted with the changes to the excise duty. We see that imported and printed banner sheetings, flex banners and unprinted PVCs have now been subject to excise duty. And now that we are headed to the electioneering period and campaign period, we see that now that advertisement costs would go high, definitely people would be impacted by this provision. Something to note for the local advertisement and marketing sector, people, is that unprinted plastic sheets also have now been subjected to excise duty at 10% of the excisable value. This would apply both to local goods and to imported goods. So this would also touch on the local manufacturers, to the local advertisement sector, sorry. Oral smokeless tobacco have also been brought into the ambit of the excise duty. Telecommunication spaces and digital payment spaces would also be touched by the changes to the excise duty now that pre-personal chip modules are subject to 10% of the excisable value in excise duty, as pre-personal chips modules are the chips that you find in your SIM cards or also on your ATM and debit cards. So this chip, as a result of this chip being subject to excise duty, we foresee a challenge, especially administratively, as the chips are already embedded in the cards. So how would the valuation of this item for the purposes of imposing of the excise duty apply? So would need a bit of clarity from the commissioner on that. Now, looking at the changes effected to the Miscellaneous Fees and Levies Act, first, we see an exemption in the import declaration fee and the railway development levy, specifically targeting construction manufacturing goods for liquefied petroleum gases for investments which are above 5 billion Kenya shillings. This coupled with the exemption on VAT, which the previous speaker has talked about. This is a very welcome move, which would incentivize investment in this area, and also the government project on less emissions in energy. We'll see also a reprieve for aircraft and spacecrafts, where they are now being given relief in a railway development levy. As they are now subject to VAT, the exemption from railway development levy would be a welcome reprieve and a relief for them. Robert touched on the CGT exemptions for the transfer of property to real estate investment trust. We also see a further exemption in terms of stamp duty, which will definitely lower the cost of transfer cost for properties, and will definitely make real estate investment trust attractive options for anyone seeking to invest in the same. A very, very welcome move. Finally, we see that the road annuity fund, which is earmarked from the road maintenance levy, has now been reduced from the 3 shillings per litre, which was currently the current rate, to now 1.5 shillings per litre, which would definitely impact the cost of the road maintenance, the fee that was set aside for the road maintenance. Ladies and gentlemen, there have been quite a few judicial pronouncements impacting the tax aspects. And let's now look at what the courts in Kenya and from our neighbors in Uganda have in terms of the tax elements. Starting us off, the Commissioner of Domestic Taxes versus Del Monte Kenya Limited, which is a case heard before the Court of Appeal. And it's a very interesting case where the Del Monte Kenya Limited had procured loans in foreign currencies. And as a settlement of this loan, it sought to it swapped this debt for equity. As a result of this conversion, it incurred some foreign exchange losses, which it sought to deduct pursuant to Section 4A of the Income Tax Act. Now, the Court of Appeal are seeking to clarify whether these foreign exchange losses are deductible, put across 2 very important factors that taxpayers in this space should note. First is the nature of loans. It observed that Del Monte Kenya procure these loans for the normal company obligations. This then translated to that these loans were revenue in nature. Secondly, it observed that Section 4A of the Income Tax Act does not distinguish realization of these foreign exchange losses, whether incurred through cash transactions or either through debt to equity transactions. And for this reason, it stated that, in fact, these foreign exchange losses are deductible for the purposes of income taxes. So very crucial point for anyone dealing with with loans in foreign exchange losses. Another interesting case which has been touched on with the first speaker on bad debts deduction, we see that High Court has aligned itself with the change that the bad debts are now deductible, especially for firms that are in lending spaces. This is the Branch International Limited versus the Commissioner of Domestic Taxes, where the High Court held that loans for the lending businesses are stock in trade. And for that reason, non-recovery of these loans would qualify as revenue losses, which are deductible. Therefore, this is a win for any microfinance companies, as they are now able to deduct their principal and interest, which they lost in bad debts. Very, very interesting perspective and procedural clarification from the High Court of Kenya in Funds Direct Limited versus the Kenya Revenue Authority, where the High Court held that the decision on placement on VAT special table for any taxpayer is an administrative decision. However, for it to be appealable before the court, it must first crystallize into a tax decision as defined under the Tax Procedures Act, capable of appeal. This is a very crucial directive, particularly given the notice earlier this year by the Kenya Revenue Authority reducing the scope of placement on VAT special table for taxpayers to reflect only missing traders. This would be a very crucial requirement for you to consider if you intend to appeal any decision on placement on the VAT special table. Lastly, from our neighboring country in Uganda, we see a very interesting ongoing case, Stanbic Bank versus the URA, the Uganda Revenue Authority, where this is a 117 billion Ugandan shillings transfer pricing dispute over related parties transaction, where the URA are challenging the intercompany fees charged to Stanbic Bank, stating that these fees are reducing significantly the taxable income that is supposed to be taxed in Uganda from Stanbic Bank. We are looking to see on the trajectory in which the Tax Appeals Tribunal will determine this matter in. And a very interesting announcement from the URA, which is also a customer of Stanbic Bank, it's that it would move all its government tax collection accounts from Stanbic Bank to other bank accounts, citing that tax compliance concerns for Stanbic Bank. This also places Stanbic Bank in a very precarious position, and therefore we will be looking to see how this case unfolds before the Tax Appeals Tribunal. Ladies and gentlemen, those are just but a few highlights from this quarter in regard to the case law. So now I would invite my colleague Robert to take us through the regional development from this quarter two. Over to you, Robert.
Thank you. Thank you very much, Maggie. And yes, indeed, it's been a very, very busy development. And just one thing that I wanted to clarify in the effective dates, just to clarify that most of those effective dates are 1st July 2026, not 2027. We have just very few of them that are due in 2027. Now, in terms of regional developments, and as we bring this to a close, what's happening across the borders? Tanzania, unlike Kenya, which you can see did not go full out in terms of new rates, we can see Tanzania trying to bring in an expansion of the tax base. So, for example, that there's an incentive for newly registered presumptive taxpayers. Presumptive tax is the one that you pay based on your turnover because you probably don't have records. So that rate has actually been increased from 3.5% to 4%. But again, there's an incentive for you to register and therefore not pay tax in the first 12 months because of that tax holiday. So the effect is that you're going to have more people on the tax register, and hopefully you can reduce the taxes. Another good one is whereas Kenya in the finance bill had proposed to enforce a distribution of at least 60% of the profit after tax, Tanzania seems to be going the other way around, and they're now saying we want to reduce the amount that can be deemed as a distributable amount from 30% to 15%. And we think that that's really a good move and probably one that we should emulate. 30 days for you to get your VAT refund in Tanzania. We are waiting to see whether that is going to be actually achieved. But again, a fantastic move, because if you compare with Kenya's 120 days if you're not under audit, or 180 days if you are under audit, we can clearly see that the Tanzania model is much friendlier to businesses. If you have transactions or related parties in Tanzania, this is an important one for you. Why? Because if TRA, the Tanzania Revenue Authority, makes a transfer pricing adjustment, and that transfer pricing adjustment results into a tax liability, then your penalty is up to 30% of that principal tax liability. So, for example, if the adjustment results in 100 million shillings worth of tax liability, then your penalty is 30 million shillings. That's quite steep. And so it's important that if you've got operations in Tanzania, have a look at those operations, confirm that you can defend your transfer pricing position, because we have seen Tanzania Revenue Authority going quite aggressively on this kind of adjustments. So that's a highlight of what's happening in Tanzania. What about in Uganda? Kenya, we were expecting, and we're still expecting to get a reprieve in terms of the PAYE rates. In Uganda, we have seen that coming through. So they have done two things. One is that they have increased the lower tax band, in tax-free band. And then two, they have introduced a new band of 25%. So what that means is that the PAYE rates in Uganda are now a bit more progressive, and that's really a good thing. The other thing is that we have seen a reprieve from an administrative perspective, where if you get an eTIMS compliant invoice, in Uganda they call them IFRIS. If you get an eTIMS compliant invoice, then you don't have to withhold. And the reasoning is simple. The reasoning is that URA has visibility of that transaction and therefore that invoice and that income. So you have no business withholding. And from an administration perspective, from a tax cost perspective, that's a really brilliant move. And we hope that we're going to get there as a country. Again, if you've got, if you're an Ugandan and you're paying a foreign lending institution, and you're required now to withhold tax at 5%. Just like in Kenya, we have an issue around the definition of royalty. Now, software has been clearly defined to include royalty, or to be included in the definition of royalty. So there's no ambiguity about whether there's an obligation to withhold tax on that. A very good one, and I can see somebody reacting there. That's a very good one. Another good one is the VAT registration threshold. That is now moved to about 10.6 million Kenya shillings. Previously, it was 5.3 million shillings, or 150 million Uganda shillings. Now, again, administratively, you can see a move to try and support taxpayers to ensure that you're reducing the cost of compliance, because when you increase the VAT registration threshold, that means that a few people fall out of that regime, and therefore you don't have to comply with the monthly filings and so on. So in Kenya, if you look at the medium-term revenue strategy, the proposal is to move that threshold from 5 million shillings, which it is currently, to 8 million shillings. So we are again waiting to see whether this is going to be implemented. And just like in Kenya, we also have an amnesty going on in Uganda. Again, so if you have any transactions that you think you may not have complied with in the past, probably an opportunity for you to have a look into that and comply. Rwanda is a very interesting one. Why? Because we didn't see a change in law in rates, tax rates specifically. What we've seen is an expansion or an attempt to expand the tax base. And one of the things that Rwanda has done is to expand the list of items that are now subject to VAT when these goods and services are traded online, basically digital services tax. So we expect that there's going to be a little bit more tax that is payable on these transactions. Again, Rwanda is saying, let us look at if we're going to give you a tax exemption, let us look at the impact from an economic perspective. And if we see that the tax we are foregoing is not commensurate with the tax or fiscal benefits that we are receiving in terms of economic growth, job creation, and so on, then we are going to rationalize those tax exemptions. So it's probably something to watch out for if you've got operations in Rwanda, and have got these exemptions. Lastly, we have seen the government of Rwanda telegraphing its intention to change excise duty rates. Again, not very unfamiliar, because if you think about the Kenyan perspective, we've seen government using excise duty to shape consumer behavior, especially where it is harmful consumer behavior. For example, increasing excise duty on sugar. So Rwanda has also indicated its intention to do that, and we'll be watching that space. So that is Rwanda. Now, as we bring it to a close, some of us have got operations in Mauritius, and one of the reasons why we go to Mauritius is the lower tax rates. But it appears that the moniker or the description of a low tax jurisdiction in Mauritius appears to perhaps be fading. Why? Because Mauritius 2 weeks ago made a proposal to increase their personal income tax rate to 35% for persons who are earning 12 million Mauritian rupees and above. 12 million Mauritian rupees is 33 million Kenya shillings. Now, the thing to note about this is, one, this rate is quite high at 35%, considering that Mauritius is generally between 15 and 20% for personal income tax. And two, perhaps it's something that we can learn from in terms of the tax band expansion. If you think about a Kenyan perspective, you hit 35% at 9.6 million Kenya shillings annually. Now, in Mauritius, you do that at 33 million. So perhaps it's something that we can think about from a Kenyan perspective. We also have a new withholding tax rate of 5% on advertising and promotion. That is for Mauritian entities. And the last one, which I think from an administrative perspective is something we should emulate, is binding compliance agreements. And how these ones work is, you've got an assessment or a review that is being undertaken by Mauritius Revenue Authority. Prior to issuing you the assessment, you agree with the Revenue Authority about the compliance obligation. And that what that does is that going forward, you're very clear about your tax obligations and your compliance obligations. So once you sign that compliance agreement, it's binding on you and the Mauritius Revenue Authority, and therefore you have predictability of that obligation going forward. So that really is a good one. And that summarizes what we have seen regionally, and we shall continue watching this space as we continue updating you. And with that, ladies and gentlemen, allow me to invite my colleague Mercy for the Q&A. Mercy?
Thank you so much, Robert. And thank you to all our presenters for such an insightful session. On to the Q&A session. I can see 4 questions on e-Teams. Robert, I will highlight them and you can address them all together, the e-Teams question, and then we can move to the other questions. We have JG asking, we have Gashao on e-Teams asking, how does the e-Teams non-compliance penalty arises, especially for SMEs, individuals, and when is this effective? We have a question from Chad Africa Limited. They would want to know, what is the update on e-Teams compliance in terms of staff reimbursement? We have a question from Mureithi, still on e-Teams. He's asking, are there persons specifically exempted from being on e-Teams? And lastly, on e-Teams, we have Guy, he's asking, is there no minimum threshold value for invoices that need to be e-Teams compliant? Robert?
Yeah, thank you. Thank you for those questions, Mercy. Quite a number of them. And let's start with the one by Guy, the last one, which is minimum threshold for e-Teams compliant invoices. There is none. So even if you're issuing invoices for 10 shillings, you are still required to issue an e-Teams invoice. And that's, if you've been following the debate, there's a question around whether Safaricom should be exempted, because whenever you do a transaction with Safaricom, let's say it's an M-Pesa transaction and the fee is 10 shillings, then ideally Safaricom should give you an eTIMS invoice for that 10 shillings invoice. But remember, Safaricom processes about 50 million transactions every day for M-Pesa. So it's KRA still hasn't come up with a solution that can allow Safaricom to issue 50 million invoices on a daily basis. So even though the requirement is there in law, practically we can see some challenges with that. So, but there is no requirement, there is no minimum threshold for you to issue invoices. And then there was a question around an update on eTIMS compliance for staff reimbursements. Now, staff reimbursements are not subject to eTIMS because that is part of emoluments. Those ones are specifically exempted under Section 23A of the Tax Procedures Act. So for as long as you can demonstrate that those are per diems, those are reimbursements, those are salaries, then you don't need an eTIMS requirement, or you don't need an eTIMS to support that. Gashau is asking, how does the eTIMS non-compliance penalty arise, especially for SMEs? When you don't issue an invoice. So for example, you've seen the enforcement guys from KRA walking around and they come to your shop, they buy something very small. Sometimes they'll even buy a pen, they'll buy a soda, they'll buy water, and then you don't give an eTIMS invoice. If they encounter that kind of a scenario, they are going to charge you with the offense of not complying with the law in terms of issuing an eTIMS invoice. And the penalty that they used to apply was up to 1 million shillings, which is why the change in the Finance Act to bring that penalty to 100,000 shillings for companies, or 10,000 shillings for individuals, or a maximum of 2 times of the tax due is so important, because now we are very clear that it is no longer 1 million shillings. You can imagine selling water for 300 shillings and you don't issue an invoice, and the VAT on that is probably what, 50 shillings, and then somebody is asking you to pay a penalty of 1 million shillings. So that is the reason why that was being moderated. I think I forget that there were many questions on eTIMS, Mercy. I'll try and come back to that one. But in the interest of time, if I just go to the questions that I can see here, can foreigners with work permits engage in import business from their country? For as long as you have the valid work permits, you can continue trading. Now, whether those goods will be exempt from tax or not depends on the classification and categorization of those goods, because under customs law, if they are exempt from duty, then it doesn't matter who is importing them, whether you're a foreigner or a local, you will still not pay taxes. If they're exempt from VAT, again, it doesn't matter who is importing, provided that they are classified as exempt. Then I can see, let me see, Mureithi is asking, how does a commissioner determine what a tax avoidance scheme is? What are the criteria? So if you look at the amendment, and maybe just to contextualize this amendment, the Income Tax Act had Section 23 of the Income Tax Act, which provided for tax avoidance schemes. The VAT Act, I think it was Section 66 or 67, I can't remember very well, that also provided for that exemption. What the law that did not have an tax avoidance scheme provision was the Excise Duty Act. And so bringing it within the Tax Procedures Act now ensures that all laws that are administered by KRA, including affordable housing and so on, all those laws that are administered from a revenue administration perspective by KRA will be subject to this tax avoidance scheme. Now, what is a tax avoidance scheme? So this is a scheme, or well, I shouldn't use the word scheme again. It's a plan or a device or a transaction that has been ordered in order to result into a tax benefit. And it's been very widely defined, because a tax benefit includes a reduction in tax liability, an entitlement to a refund, and the scheme includes an undertaking, a plan, or a proposal, whether or not it's legally enforceable. So it's very widely defined. But the idea is that if you organize your transaction in such a way as to reduce your tax liabilities, then you are at risk of KRA challenging that as a tax avoidance scheme. And globally, what we have seen authorities do is look at the principal purpose of the transaction. If the principal purpose of the transaction was to avoid tax or to reduce your tax liability, then you probably have a risk. But if there's a commercial rationale for that transaction, I think you can argue that it was not a tax avoidance scheme. And then your question was, are there persons specifically exempted? Yes, there are some people who are exempted. You cannot, if you are paying for employment services. If the banks are issuing you their costs, those are specifically exempt. Airline tickets are other people who are specifically exempt from issuing e-Teams invoices. So that list of exemption is actually provided for in Section 23A of the Income Tax Act, of the Tax Procedures Act, sorry. Eric is asking, does deemed dividend rules apply in Kenya and what is the rate? No, they don't apply. And this is the reason why the finance bill had proposed to deem at least 60%. So those ones, that provision did not go through Parliament. It was a very interesting debate. It was actually reduced to 40% on the floor of the House, and they eventually then reduced to removed altogether. So we don't have that in Kenya. Then what is the current KRA position on prior year losses? So current position is that they are disallowing anything that is older than 5 years as of July 2025, which we think that is a big problem and certainly will result in a dispute. Jen Rose is asking, are there any tax losses appeals at the TAT on the interpretation? No, and we are actually itching to see one, and one of our clients has been affected by this, so we expect that they'll be going to the tribunal, and certainly we'll be keeping you updated on that. Is there a directive regarding provision of PI bans in Kenya? No, there's no directive. We're waiting for the CS National Treasury. He's on record as saying again that they're looking into that, and so we're all waiting for that. Chris, yes, certainly the slides will be available on our handles, as you can see there. Definitely we will let you have those. Then Catherine lastly is asking, beyond raising additional revenue, what metrics will the government use over the next 12 months to determine whether the Finance Act 2026 has been successful in supporting economic growth, investment, and job creation? Fantastic question. Actually, there's the Finance Bill 2027 cycle has started, and there's an ad that has been raised by or issued by the CS National Treasury, inviting stakeholders. So I think we all need to come in and get involved right from the budgeting side of it, not just the financing part of it, so that we can then give our inputs into the metrics. We hope that this will be shared, and Catherine, it will be interesting to see what your proposals would be, and anybody else here, what the proposals would be around those metrics, so that we can then say, indeed, this is a positive impact on the economy. So thank you very much, ladies and gentlemen, for that. I know we are now exactly 1 minute after the hour, and I'll hand it back to Mercy for closure. Mercy?
Thank you so much, Robert, for answering those questions. And ladies and gentlemen, that's all we had for today. Please feel free to reach out to us on the email on the screen for any clarification or inquiry. You can also interact with us on our social media handles, and even better, visit our website at www.ichiban.co.ke, and one of our advisors will get in touch. Please remember to fill the survey on the chat. We welcome your feedback. Thank you so much for joining us today. Have a lovely day.